Every single activity is either passive or non-passive. So even if you're not investing in real estate, technically you're still subject to these rules. So it's kind of funny because every American out there is subject to these rules, but they just don't know it until they actually get into real estate. And then they realize there's this whole set of, shadow rules that exist that you have to try to learn. But every activity that you earn money in is subject to these rules. So every dollar that you earn is either passive or it's non-passive. So we've got two buckets of income, passive and non-passive. Every single dollar that you earn flows into one of those two buckets. Passive losses or passive activities come with limitations. So if I have a passive activity that generates a loss, a tax loss, that tax loss is called a passive loss because it's a passive activity and it generates a loss. So that makes sense, passive loss. But the problem is that my passive losses cannot offset my non-passive income. So as an example, I might have W-2 income, or like I run my CPA firm, right? So that's non-passive business income because I'm materially participating in it. And we'll go over some of this stuff here in a minute. But if you have W-2 income or business income where you're materially participating, that's non-passive income. Interest, dividends, gain on stock sales, that's also considered non-passive income. So your rental losses cannot offset that income because it's in a different bucket. Your rental losses are in your passive bucket. All that other income that I just described is in your non-passive bucket. So it's important to understand these rules because part of understanding these rules is first just understanding where my income flows. What bucket are we talking about, passive or non-passive? But the other part of this is figuring out how to move passive losses out of the passive bucket and into the non-passive bucket so that it can offset my W-2 income, my business income, gain on stock sale, interest, dividends, all of that type of stuff. I preach this stuff all the time. So if you've been on if you've seen any of our content, listen to our podcast, you're probably already pretty well aware of the passive activity loss rules, but I preach it because a lot of CPAs get really confused with Section 469, the passive activity loss rules. So it's really important that you understand how this works. Now, there are exceptions to the passive activity loss rules, which we'll go over. And then there's also a special loophole for short-term rentals and VRBO owners, or Airbnb and VRBO owners, which I don't actually know that we're going to touch today, but I wanted to include that there just in case you're interested. Now, why do we even have these rules? It's really important to understand why we even have these rules, because it's important to understand this because once you understand why we have the rules, you'll stop trying to skirt the rules, if that makes sense. Everything has to be by the book when we're talking about Section 469. It's a highly litigated area of the code. Section 469, whenever I say Section 469, I'm talking about the passive activity loss rules. So you don't want to just go and say I'm a real estate professional or I'm materially participating in my short-term rentals and I'm creating these non-passive losses without really doing it right, substantiating it, having those time logs, making sure that you're going to win those audits because you will get audited. If you want to challenge the audit, you're going to tax court. It's highly litigated area of the code, highly audited area of the code. So the reason that Section 469 exists, back in 1986, Congress implemented this new code section. So before 1986, there's no such thing as passive activities. I could be a physician earning a W-2 wage, $1 million, and I could just go buy a bunch of real estate. I could use the depreciation to create tax losses, and I could completely wipe out my W-2 income. I could invest in syndications. They would pass me back a passive loss, or not a passive loss because we're pre-1986. They would just pass me back a loss, and I could use that loss to wipe my W-2 income out. So Congress stepped in and said, it's not fair that somebody that's not in real estate, they've got their bulk earnings somewhere else. It's not fair that they can just go and buy real estate as a tax shelter and offset their earnings. So they created the passive activity loss rules. And again, those passive activity loss rules say that rentals are passive by default. And you can qualify for exceptions to move them out of that passive bucket. But if your rental creates a loss, it's trapped in that passive bucket. It cannot move outside and offset your W-2 income, your business income, or anything else like that, unless you qualify for one of those exceptions. And if you don't have any other passive income, let's say you buy a rental property, you don't qualify as a real estate professional, you don't qualify for one of the other exceptions to the rules. So you just buy this $100,000 rental property, you cost segregate it, you get a $30,000 tax loss in the first year. That's a passive tax loss. There's no other passive income. You're not selling any rentals. So there's no passive gains. So you just have a $30,000 passive loss. Well, if you have nothing to offset it with, if you have nothing to apply that loss to, then it becomes a suspended passive loss. and it just carries forward on your tax returns until you die. So that's what these rules are in effect for. It's to prevent people from investing in tax shelters. So Congress looked at rental real estate as a tax shelter. And it's really important to understand that concept, because whenever we're working with like new clients on real estate professional status, it's typically like an education portion, and then like a pre-audit defense portion of the engagement. And we always have to go over this history, because it pre-frames the rest of the engagement. It pre-frames the entire strategy, because we get people that come in all the time that say, I work 2,000 hours a year, but I qualify as a real estate professional. And we tell them, you can't. There's no way. You're going to lose 100% of the time. And they go, well, I want to take that position anyway. And because, I'm not scared, it'll be fine. But the point is, you should be scared because the passive activity loss rules are meant to stop the loophole. They're not. Real estate professional status, short-term rentals is not technically a loophole, right? The passive activity loss rules were implemented to stop the loophole. The loophole was just buying rental real estate to offset my W-2 income. It's really important to understand, because it kind of just gives you the frame of mind that Congress has, that the IRS has whenever they're auditing you, and just kind of helps you understand how to protect yourself. All right. So passive activity, kind of been talking about this, all rental activities, regardless to the extent of which you participate, unless you qualify as a real estate professional, and any trade or business in which you do not materially participate. Those are both passive activities. So all rental activities, unless I qualify as a real estate professional, and any trade or business that I don't materially participate in. All right. So that's a passive activity. So that means I'm going to be stuck in that passive bucket unless I qualify as a real estate professional, or unless I materially participate in my trade or business, right? So what are some examples of this? Well, I buy a single family home. I invest in a syndication. It's all going to be passive by default, unless I qualify as a real estate professional. Any trade or business. Maybe I go and put $100,000 into the local hair salon. I always talk about hair salon investments. I think those are great investments because it's cash flow positive. Even in the pandemic, they were crushing it, at least around Raleigh. They're doing a lot of like the black market stuff. So yeah, and I have a funny story about like my wife shaved the back of my head and unintentionally gave me a nice racing stripe during the pandemic. So I'm all for barbers and hair salons. So you put $100,000 into a hair salon. You're not materially participating, right? You're just the money guy. Put $100,000 in. You don't have any voting rights. You're not involved in the day-to-day operations. You're not making any decisions. You're passively involved. That's a passive activity for you. That's a Section 469 passive activity. So it goes into the passive bucket. That income goes into the passive bucket, right? So that's what any trade or business in which you don't materially participate. That's what that means. I'm not materially participating in this hair salon investment. So it goes into the passive bucket and it sits there. But cool thing about that is, and this is where you have to understand what these rules mean, because your CPA is going to be confused. Cool thing about that, if I do invest in that hair salon, and let's say I put $100,000 in, I get $10,000 in profits back. Well, those profits are passive income, right? Well, guess what I can net that out against? I can net that out against my passive losses. What creates passive losses? Rental real estate creates passive losses. So you don't have to have like the same business offsetting each other. You don't have to have one rental, offsetting the same rental. Rental A can offset rental B, can offset syndication C. Syndication C can offset passive business Z. So as long as it's passive, it all flows into one bucket. It's all considered one piece of income. Everything nets out. Really important concept to understand. And that's kind of like that rich dad, poor dad concept of like buy businesses and expand your cash flow over time. Well, apply that, but then also apply the passive activity loss rules and you won't pay tax. And some of our clients do that. So we have clients that earn $300,000 plus a year and they pay $0 in tax. And if you think about that, like in a reverse, like kind of manner, that's like grossing $500K a year, right? After tax. So really cool concept to understand. Well, all rental activities are passive. Any trade or business that you don't materially participate in is passive. So that one exception that we're going to go over, there's 3 exceptions, but the one that I want to point out is down here. Number 3, qualify as a real estate professional. I'm actually going to skip 1 and 2 for the interest of time, but I'll send these slides over so you can go back and read these if you want to. But qualifying as a real estate professional allows you to avoid the passive activity loss rules for your rental activities. To qualify as a real estate professional, you have to spend more than 750 hours or more in a real property trade or business, or real property trade or businesses. It can be multiple. And you have to spend more time in real estate. The technicality says more than 1/2 your service time. But basically what that means is more time in real estate than you do anywhere else. So when I use that, like that physician that says, "Oh, I want to be a real estate professional, but I spend 2,000 hours being a physician." Well, more time in real estate means an additional 2,001 hours in real estate on top of your physician hours. So you're working a total 4,001 hours during the year. I think that comes out to be like some 80 hours a week, which is doable. I'm an optimist. I believe that you can do it. The problem is the tax court's not going to believe that you can do it. They're always going to strike you down. We have years and years and years of case law where people have tried and they all lose. So you have to meet both of these tests. I'm just going to get my laser pointer up here. You have to meet both of these tests: 750 personal service hours in real property trades or businesses in which you materially participate, and more time in real estate than anywhere else. So if you can meet both of those tests, you are a real estate professional for tax purposes. And if you can also show that you materially participate in your rental activities, which is subject to a separate set of tests, then your rental activities will be successfully moved out of the passive bucket and into the non-passive bucket. And the reason that is so important is maybe my wife has W-2 income of $500,000 and I'm just the guy that manages the rentals. So we go out and we buy a $700,000 triplex. I cost segregate it. I bonus depreciate it. I'm going to yield a $200,000 or so tax loss in the year of acquisition. That's the way that cost segs and bonus depreciation work, right? So I've got a $200,000 tax loss. Well, by default, that tax loss is passive. And if I don't have any passive income, if I don't have any other, gains from passive activities that I'm liquidating, then that $200,000 passive loss just gets suspended and carried forward. I don't get to claim it in the current year. It just gets carried forward until I can claim it at some future point. But if I'm a real estate professional, if I've spent 750 personal service hours in real property trades or businesses, and if I've spent more time in real estate than anywhere else, now that $200,000 loss from my triplex that I bought, it moves out of the passive bucket and over into the non-passive bucket. And what else is in the non-passive bucket? My wife's $500,000 W-2 income. So moving that, or qualifying as a real estate professional, moving that loss into that non-passive bucket, that $200K loss, saves me probably $60,000 at the federal level, probably another $10,000 to $20,000 at the state level, depending on what state you're in. We're talking about $70,000 to $80,000 of tax savings. And if you think about it a little bit further from an investor standpoint, if I buy a $700,000 triplex and I put, 20% down, I put $140K down, right? But then I immediately get $80,000 back in tax savings. I'm net into this property $60K. But I've got all the nice conventional terms of a 20% down loan. So pretty sweet deal, really de-risks real estate for me, as long as I'm able to qualify as a real estate professional and use those passive losses or move those passive losses into that non-passive bucket in order to utilize it today. Now, we're going to switch into talking about syndications, because you can do the same thing that I just talked about, buying that $700K property. You can do the same thing with syndications. So I could put $100,000 into a syndication. Most of our clients that put $100,000 into a syndication today are receiving an $80,000 to $95,000 passive loss back, because the syndication is buying a $10 million building and they're cost segregating it and creating a large tax loss, right? Like to give you some numbers, let's say that the syndication buys a $10 million building, but they raised $3 million to buy that $10 million building. And let's say that they cost segregate it and the tax loss is $2.7 million. Well, $2.7 million of a $2.7 million tax loss compared to $3 million of capital raised is 90%, right? So if I put $100,000 into this syndication, 90% of that's going to come back to me as a loss. So they're going to in box 2 of my K1, it's going to show negative $90,000 of rental income is what I'm going to receive. Now, the question for me is, can I use that $90,000 of loss? And most people cannot. Most people, you're subject to those passive activity loss rules. You're not a real estate professional. But if I do qualify as a real estate professional, and if I do have my own rentals, I can group that syndication investment in with my own rentals, and I can reclassify that $90,000 loss from that passive bucket and move it into that non-passive bucket. So it can be a really good, like if you're structured for real estate professional status, if you're structured for material participation with your own portfolio, you can really juice these losses at the end of the year. So, highly recommend exploring that with your CPA. But we're going to talk a little bit more about that here. All right. So the first thing to understand is we got to look at a Form K-1, right? Now, I'm a big fan of Game of Thrones, even though the last season wasn't that great. But we've got Lannister LLC. That's the partnership. And we've got Jon Snow. That's the actual partner. So if you invest in a syndication, this is what it's going to look like for you, right? You're going to have your information here, the partnership information here. They're going to show you your percentage interest down here, profit, loss, capital, beginning and ending. You want to make sure that's correct. Typically, you're going to see something in qualified non-recourse financing. Qualified non-recourse financing is non-recourse financing secured by real property. So all of these syndications have qualified non-recourse financing. Really important to double check this number because this is going to give you a basis to take losses. And I know that probably goes over people's head, but that is, I'm not doing it justice on this talk. It's extremely important to understand that aspect if you're investing in syndications. Qualified non-recourse financing gives you basis to take tax losses. So I could put $0 into a deal, but be allocated $1 million of qualified non-recourse financing. And I can take $1 million of losses from bonus depreciation and tax deductions, even though I put $0 into the deal. So make sure that you check out that qualified non-recourse financing. If you're investing in a syndication and you see non-recourse financing, most likely the CPA prepared it wrong. It should always, 99% of the time, be qualified non-recourse financing. But you're going to have your beginning capital account. If this is the first year of the syndication, your beginning capital account is $0 because you didn't have anything carrying over from the prior year. You contribute $50,000. Your net loss that's allocated to you is $35,000. So now you have your ending capital account of $15,000. Really important to track this information for two reasons. One, at the end of the deal, when the syndication liquidates, that $15,000, that's what you're owed. That's what they're going to pay you, right? So you need to track that to hold them accountable to good accounting. But the second reason that you should track that is you can't take a distribution in excess of $15,000 next year unless you're allocated profit. So you got to be really careful. Otherwise, you're going to create a tax event. So on the right-hand side here, we have the actual, like how the property actually performed. And right here, I've just got a negative $35,000 of net rental losses. So this property they probably did a cost segregation study. They passed back, was that 75? Was that 85% of the, is that 85? 10, 20, 25. I don't know. I got a head cold. So anyway, you can correct me on the math, but they passed back a good chunk of that initial investment in terms of losses. So I received this K1, but now I'm looking at it and I'm going, well, what do I do with this $35,000 loss? It's still subject to that passive activity loss rules, right? It's going to flow to Form 8582, the most important form that everybody should know. Form 8582, if you're not aware of it, Rick at the beginning mentioned our Facebook group. I'll post a link to it later when I get a break here in a minute. But our Facebook group is Tax Smart Real Estate Investors. I think if you have to go to Facebook.com/groups/Tax Smart Investors, you'll find us. But we talk about this a lot. Form 8582 is the most important tax form that you need to know, above and beyond your 1040, above and beyond Schedule E, above and beyond Schedule C. The reason is nobody looks at it. And that's where all of your passive losses are being allocated and aggregated. And if you switch CPAs, the new CPA might forget to bring it all forward. So now you just lost hundreds of thousands of dollars of tax losses. So you got to be really on top of Form 8582. But this $35,000 loss, if I'm not a real estate professional, then this is passive, right? So it flows to Form 8582. I've got a $35,000 loss that's reported on Form 8582, and I'm going to net it out against any other rental income, rental gains that I have from selling rental real estate, any other passive business income. But if I'm a real estate professional, and if I've materially participated in my real estate properties, then I can group this deal in, and I can use that $35,000 loss immediately to offset my W-2 income. So it's going to flow to Schedule E. And then it's going to flow into my 1040 and directly offset my W-2 income, my business income, and all of that good stuff. It's really important to understand that. Here's the important thing to understand about your K1s. When CPAs that don't understand Section 469, the passive activity loss rules, really important to understand. When they don't get it, they look at box 2. This says net rental real estate. And what are they automatically going to code it to be? Because all of our software does this. All of the tax preparer software, it just by default codes it as passive. So they're going to look at that and they go, yeah, that's fine. We'll just move that along. They're not going to look to see if you're a real estate professional. They're not going to look to see if you're aggregating this activity in with your other rental activities. They just see box 2 and they go, oh, must be passive. Conversely, we also see CPAs see box 1 filled out. Like maybe I'm investing in like an ATM syndication, right? In the ATM syndication, the way that works, I put $50K in, you buy a bunch of ATM machines. The first year, it's 100% bonus depreciation on your capital expenditures because ATMs are 5-year property. So I immediately expense everything. So I'm going to have a negative $50,000 in box 1 when I'm investing in an ATM syndication. And when that happens, we see CPAs take the opposite approach. They go, oh, ordinary business income must just go right to Schedule C or must go to your Form 1040, goes right to it. They completely disregard the passive activity loss rules. And so when you get audited, even though you have a number here in box 1, the auditor is going to apply Section 469 of the passive activity loss rules. And guess where that box 1 number should be going? It should be going to Form 8582 with all of your other passive income and losses. So don't get suckered in to a CPA asking you. We just had this pop up in our Facebook group the other day. Somebody was like, and my CPA is asking me what box is the number going to be reported in, box 1 or 2? And I was like, it's completely irrelevant. It doesn't matter for the passive activity loss rules, because I know what that CPA is trying to think through and they're not doing a good job of getting to the answer. So you have to protect yourself. You have to prevent audits essentially, or you have to protect yourself in the event of an audit. So don't get suckered in to thinking, oh, since it's reported in box 1, must just go straight to my 1040. I don't have to worry about the passive activity loss rules. No, that's not true. The passive activity loss rules are all about how much you personally materially participated in the deal. So if I invest in that ATM syndicate and I've got a negative $50K in box 1 and I haven't done anything except put capital up, it's passive and it's going to flow to Form 8582. And that passive loss, even though it says ordinary business income loss, still passive. And it's going to be suspended and carried forward if I don't have any other business income. We see deal sponsors mess this up sometimes too. So you got to be really careful. You got to be really, really careful about how this K1 is going to be reported. At the end of the day, though, in really simplified terms, you either materially participated or you did not. And if you did not, it's passive. If you did, it could potentially be non-passive. So we've got basis and partnerships. We can't go below $0. That was kind of our capital account there. It's not technically capital account. Basis and capital account are interchangeable, but they're not. And I don't want to get into it because that's a very long discussion. But essentially, your basis can't go below $0. So that $15,000 capital account, next year, I can claim a $15,000 distribution. If I'm allocated more profit, my capital account goes up. My basis goes up. So maybe I'm allocated next year $10,000. Now my capital account goes from 15K plus the 10K, right? So current year net income, right there. So it's going to go to $25,000. Now I can take a $25,000 distribution. In the year that we sell the property, I'm going to be allocated gain. Maybe I'm allocated $50,000 of gain. Well, my capital account is increased by $50,000. So I can take that much more in distributions. But what I can't do, I can't take distributions when my capital account reaches $0. That will create a taxable event for you if you're a partner in a syndication. Syndications is really important to review operating agreements. So I know that this is like not fun for limited partners, right? But you will get a lot of insight into the tax attributes that the deal sponsor is trying to push when you review the operating agreements. I've got 3 sections here that I want you to review every single time. If you don't know how to review it, that's totally fine. Just get with a CPA that knows how to review it. They'll do it for you. We charge our clients to do it for them, and they're very happy when we're able to come back to them and say, this is, even though the sponsor says this is the economic deal that they're trying to reach, their operating agreement says that tax benefits are actually going to flow X, Y, and Z way. So you want to review the profit and loss section. The profit and loss section is going to show you how profits and losses are allocated between all the members in the syndication. It's also going to show you typically how the debt is allocated. So that qualified non-recourse financing that I was talking about earlier, it's going to show you how that is allocated. And again, that's important because it gives you basis to take losses. Qualified non-recourse financing gives you basis to take losses. You want to review that distribution section. In the profit and loss section or the distribution section, you're going to see the waterfalls, right? When I achieve X% IRR, we're going to do Z thing, whether that's an allocation or whether that's distribution to my members. But the distribution section is going to tell you who gets paid what and when, and what that waterfall looks like, what that distribution waterfall looks like. And then the liquidation section is very, very, very important to review, because that's going to tell you what happens when the deal liquidates, who gets the gain and who gets how much of the gain, and what waterfall provisions are we looking at there. Sometimes we see waterfall provisions different in a liquidation section than a distribution section. Most of the time, the liquidation section points to the distribution section. So it'll say like, we're going to liquidate in accordance with section XYZ, which is the distribution waterfall in that prior section that you've already reviewed. But these are the three really important things that you need to review if you're going to invest in any sort of syndication: the profit and loss section, distribution section, liquidation section. Really important to understand that most attorneys pull templates online related to the tax attributes of operating agreements. So you really need this reviewed by a CPA with partnership experience. When a syndication liquidates, I think this is my last slide. When a syndication liquidates, you have multiple types of taxes. You have Section 1245 and Section 1250 recapture tax. You have unrecaptured Section 1250 gain, and you have Section 1231 gain. Now, these do not stack. Okay, so if I have $100,000 of gain, $30,000 might be 1245 and 1250 recapture. $20,000 might be 1250 gain, and the remaining $50,000 would be 1231 gain. But let me go through these real quick. Section 1245 and 1250 recapture. Let's start with Section 1245. Section 1245 is gain. Think about it as gain from bonus depreciation on my 5-year and my 7-year property. So if I go do a cost segregation study on a new rental property, that cost segregation study is going to say, even though we're supposed to depreciate everything over 27 and a half years, because that's just statute, in reality, my carpet is not going to last 27 and a half years. My appliances are not going to last 27 and a half years. The parking lot is not going to last 27 and a half years. So cost segregation study says, we just bought this $100,000 building, but we're going to take that $100,000 of value and we're going to allocate it into various buckets. We're going to go and identify all these components that make up the property, and there's going to be a value that comes after that identification. So we're going to have a 5-year bucket, a 7-year bucket, a 15-year bucket, and a 27.5-year bucket. And when I say bucket, I mean value allocated to that depreciation life. So we're going to have value allocated to a 5-year life, a 7-year life, a 15-year life, and a 27.5-year life. Bonus depreciation allows us to immediately expense anything with a useful life of less than 20 years. So I do a cost segregation study. I allocate 30% of the purchase price to 5-year, 7-year, and 15-year property. But I also get to immediately expense it because of 100% bonus depreciation. So I immediately expense 30% of the purchase price. That's where I'm getting these big tax losses from in the presentation. The problem with bonus depreciation is that it's going to create large recapture taxes whenever you sell at the end of the day. And the reason that it's going to create recapture tax is the simplest way to think about this. I have $5,000 worth of carpet. It's 5-year property. I 100% bonus depreciate it. I take it all up front. When I bonus depreciate my carpet, I get a $5,000 write-off, but now my basis in the carpet is $0 because it was $5,000, but I took the $5,000 write-off today. So now my basis is 0. So if I sell my property later, I'm going to have to assign $5,000 of the sales price to my carpet, unless I do some unique things, which some people do. But if I don't, I assign $5,000 of value to my carpet. So now my carpet at the sale has a $5,000 valuation, but my basis is $0 because I took all that bonus depreciation up front. And because of that, I have a $5,000 gain. And that is Section 1245 recapture. I recapture Section 1245. And Section 1245 means 5-year and 7-year property. I recapture that at my ordinary tax rates. So I don't get preferential tax rates or anything like that. I'm recapturing that $5,000 carpet at my maximum 37% tax rate. Section 1250 recapture is a little bit different, but you're also recapturing that at your ordinary tax rates as well. Then we have unrecaptured Section 1250 gain. Not to get too confused, there's 3 types of recapture here, if you can't tell: Section 1245, Section 1250, and unrecaptured Section 1250. But my unrecaptured Section 1250, that's at a maximum 25% rate. That's the recapture on the depreciation that I've claimed related to my building. So much more preferential. And then I have my Section 1231 gain. But you can mitigate this tax because at the end of the day, like if I invest in a syndication and I put $100,000 in, they give me $80K of bonus depreciation. My basis is $20K because $100K in, $80K loss, pass back to me. Basis is $20,000. They sell it for $150. My share is $150. Well, what's my gain? My total gain is $150 minus my basis. So my total gain is $130,000 in this syndication deal. Lots of taxes coming from that. But I can buy my own rental property. And it's all passive, right? So it's all fine. I don't have to do anything crazy. I don't have to be a real estate professional. I don't have to do the short-term rental loophole. I just buy my own rental property. And I'm going to offset this $130K gain with a cost seg and bonus depreciation from acquiring my own rental property. I can also take the distribution that I've received from this syndication and invest it in the next syndication, as long as it's all within the same calendar year. And guess what? The next syndication is going to give me another $80,000 loss that I'm going to apply to that $130,000 gain from the prior syndication. You're effectively doing a 1031 exchange without actually doing a 1031 exchange, without being held, accountable to the deadlines and paying for the costs. You're just redeploying cash, but all within the same calendar year. And it doesn't matter. Sometimes I get the question of, well, if the syndication liquidates in December, I don't have any time to reinvest. Well, you could have bought a property in January, not knowing that the syndication was going to liquidate in December, or you could buy a new syndication deal in January or February, whenever. The timing doesn't matter as long as the acquisition of the new syndication or new deal and the liquidation of the current deal is all within the same calendar year. So, and I just realized I don't have a contact page, but that was my last slide. So that's it. Thank you very much for letting me come and talk, and we can get to questions.
Brandon, we'll put up a slide or something with your contact info at the end.
Thanks.
That was awesome. That was power packed. Are you able to, you want to just read through the chats? There's a lot of good questions. I say we hear from the people first. I have questions, but let's hear from the people. You want to just read through that?
Yeah, sure. Yeah.
Or we can read them. I think.
So Chris Tanner asked, how do we explain to another CPA or prepare the short-term, not passive losses against our earned income? You would need to give them the code section. And I don't know what that code section is. It's code section 1469-515. I think it's 5T. 5T. It's material participation. Where's my here? Actually, here's a better thing to do. Give them real estate professional status.
Give them the case.
What's up?
Give them the case, you mean?
No, you can link them up to our article that I just posted there on real estate professional status. Sir. Yeah, there's a section in there on short-term rentals. It's got all the citations and everything. So I would just point them to that. Your short-term rentals. Short-term rentals, you don't have to. It's a unique area of the code where it skirts the passive activity loss rules. You don't have to qualify as a real estate professional. You just have to materially participate. So it's a lot lower bar. A lot of our clients buy short-term rentals to offset their W-2 income. Like you can work full-time, a full-time W-2 or a full-time business, buy a short-term rental and have the short-term rental losses offset your W-2 or business income. Really, really unique piece of the code. But a lot of CPAs don't know that. So, but we've got that article I just posted. It's all cited out for you.
Appreciate it. Thank you.
No problem. All right, Moses, you said, can you deduct an LP loss if you're a qualified real estate professional off your W-2 income or other active real estate rental income? So you can always deduct LP losses off your rental income, right? Because it's passive loss versus passive income. So that's fine. Or if you sell a rental property, you can take your LP losses and offset your rental like gain on sale. So that's all kosher. That's fine. If you're a real estate professional and if you materially participate in your own rental portfolio, because you can't materially participate in the LP deal. So I would have to be a real estate professional. I would have to buy properties local to me, right? So I'd have to own a few local rentals that I materially participate in. Then I invest in the syndication, and then I make an election with my tax returns to group the syndication investment in with my rental properties where I already materially participate. Now my limited partnership loss is non-passive. So you would have to buy your own rental real estate, qualify as a real estate professional, and materially participate on your own rental real estate, then go place your syndication investments. And yes, you'll be able to count those syndication investments as non-passive against your W-2 earnings. But you'd still have to qualify as a real estate professional. So subject to those rules. All right, Joe, you asked, but what if what if a property management company is managing the triplex in your example? Yeah. So in my example, I was basically saying my wife earns $500,000. We go buy a triplex. I'm the one that is managing everything. I do all the day-to-day stuff. I'm a real estate professional and I'm materially participating. So it's a non-passive activity. When I'm a real estate professional and I materially participate, I move it out of the passive bucket and into the non-passive bucket. And that's what I want to do, especially if I'm going to buy something like high in cost, because I'm going to cost seg it. I'm going to bonus depreciate it. It's going to offset W-2 income, business income, all that good stuff. I don't want it to be stuck in the passive bucket. So I want to be a real estate professional. I want to materially participate. But Joe's question is, what if you have a property manager managing that triplex? Well, if I have a property manager managing that triplex, most likely I'm not going to be materially participating in that triplex. So most likely I'm not going to be able to use that as a non-passive loss. It's going to be stuck in that passive bucket. The exceptions to this are when I have a lot of property, right? Or I'm the sponsor in a syndication and this asset's massive, right? That's different. Even though I've got a property manager managing the day-to-day, I'm still heavily involved in the day-to-day operations. So that's what you kind of have to think about. Is that am I materially involved in the day-to-day operations or not? And if I'm not, I might not be materially participating and I might not be able to claim this loss as a non-passive loss. It might be stuck in that passive bucket. And this could be true even if I'm a real estate professional, because I could be a real estate broker and I'm going to meet the 750-hour test. I'm going to meet the more time in real estate than anywhere else because I'm a real estate broker. It's all I do. So I'm a real estate professional. But if I don't materially participate in my rental activities, all my rental activities are still passive. So you have to hit that material participation piece, and a property manager can nix that for you because the property manager is the one that's materially participating in the day-to-day operations of the activity, not you necessarily. Kind of depends on the facts and circumstances, but we've seen it happen.
Hey, Brandon.
Yeah.
Along those lines, wouldn't let's say who was it who asked that? It was Brandon who asked that question. Another Brandon or who?
It's Joe.
It was Joe. Sorry, Joe. So wouldn't Joe be the equivalent of like an asset manager? Isn't he managing the property manager, and isn't an asset manager in a syndication managing the property manager? Aren't they sort of the same thing?
Yeah. It's pretty equivalent. The difference is that we've not seen tax court cases on the attacking syndicates. So I think that the assumption is that a syndicate asset manager is much more than like an individual checking in with my property manager once a month on my triplex. Mm-hmm. And there's just a differing level of duties and responsibility, I think. Okay. So, but that is something that we've talked about internally because I've posed that question. I'm like, well, are any of the sponsors real estate professionals then if they're not really doing the day-to-day stuff, if they're just kind of managing the asset? We got CPAs on my team that are on both sides of the argue both sides of the coin, which is interesting. So, but I think if you're in the syndication deal, you're on the GP side, not the LP side. You got to be on the GP side. If you're on the GP side, you're probably fine claiming real estate professional status, claiming material participation, as long as you meet the hour thresholds. But if you go out and buy your own 3-unit property or whatever, and you have a property manager do everything, and you're just kind of checking in with them on a monthly basis to get a financial update, that's when you're going to get kicked out. You're not going to be able to count that time.
Okay, cool. Thank you.
Yep. Great question.
Who's next? Vid's question. You see that one?
Yeah. So Vid, you asked, are there any restrictions on using passive real estate losses if you own a property internationally to offset profits from a U.S. investment? So, the only difference that I'm aware of is that you just depreciate the foreign property on a different schedule than you would normal property. I'm not 100% sure if you can use bonus depreciation or not, but you can use tax losses from foreign property to offset your domestic real estate holdings. I mean, the U.S. is a worldwide tax country, right? So they tax you on your worldwide income. And because of that, you also get to use any sort of foreign real estate, that any sort of tax sheltering that it would produce, you can use that against your domestic income. All right, Brandon, you asked, doesn't keeping tax loss in the passive column help against having to do the 1031 exchange? Great question. Yeah. So let's say, so Brandon's basically saying, maybe I don't want to be a real estate professional. I'm going to go buy this $1 million property. I'm going to not cost segregate it, and it's just going to generate $50K of tax losses a year, and I'm cool with that. I don't have any passive income, don't have any passive gain, and I don't want to do the work to be a real estate professional. So it just generates passive losses, and it just gets suspended year after year after year, and it just builds up over time. When I go to sell something later, maybe that property, maybe it's different property, if I have a ton of suspended passive losses, then I don't have to go and do a 1031 exchange, right? Because the gain would be offset by the suspended passive losses that I'm carrying forward. Sometimes we actually get clients who are in the middle of a 1031 exchange and they're carrying forward hundreds of thousands of suspended passive losses. And we're like, your gain's 50K. Don't do a 1031 exchange. You've got hundreds of thousands of suspended passive losses that will offset this gain. Don't worry about it. But on the flip side, if you can qualify as a real estate professional, you should always claim the losses up front because of the time value of money theory, right? So if I go to the grocery store today and I have $1 in my pocket, a hard, cold dollar bill in my pocket, go to the grocery store, walk to the back of the store to the milk section, I look for a half gallon of milk, and just so happens to be $1. My wife texts me and I'm like, I get distracted and I forget to buy the gallon of milk. So I go home, the $1's still in my pocket. I wash my jeans multiple times for the next 12 months. And then I go back to the store, same pair of jeans, and 12 months later, and I walked back. My wife's like, go get that gallon of milk. Our 2-year-old is screaming and he needs the milk. I'm like hustling back there, ready to buy the half gallon of milk. It's now $1.03. Why? Because of inflation. Cost of goods go up over time. So it was $1 12 months ago. Now it's $1.03. I'm like, cool, no problem. I've got money. I reach into my pocket. I pull out my dollar bill and I can no longer buy that gallon of milk because I don't have the extra 3 cents. I only have that dollar bill that just sat in my pants for 12 months. That's my eroding purchasing power. The same thing happens with your rental real estate because in every acquisition that you make, you have predetermined tax benefits built into every acquisition. And it's your choice on when you utilize those tax benefits. And you should be utilizing them upfront as fast as you possibly can, because over time, the tax benefit, the value of the tax benefit is eroded. And think about the last 12 months. Your tax benefit, if you haven't been doing this cost seg, you haven't been taking those tax losses, it's eroded by 15%. That's the increased cost of capital around the US today because of our loose monetary policy. So every acquisition that you make has these predetermined tax benefits in it. It's depreciation, right? And you should be accelerating it and taking as much as you can up front so that you can get the tax benefit today and reinvest it today. Put it in Bitcoin or Dogecoin or whatever you want to do, right? Doubles in value every year. Why would you want to do that? So good question. Yes, if you have suspended passive losses, you don't have to do a 1031 exchange, but don't be the person that says, well, I don't want to do the cost seg. I don't want to do the bonus depreciation. I just want to take regular depreciation over time. No, you're killing yourself. Your tax benefits are gone by year 10. Even though you've got 17 more years of depreciation on that asset, it's over for you. Take it all up front, maximize that time value of money. All right. Brady, yes, do stocks count in the passive bucket? Good question. They do not. So stocks, interest, dividends are specifically called out in section 469 as not from a passive activity, which basically puts them into the non-passive bucket. Seems weird, but Congress essentially doesn't want you using rental losses to offset your stock gains. So they want you to work harder than that. Oh, thank you, Rick, for posting my Facebook group. I appreciate that. All right. Felipe, am I saying your name right? Philippe. You got me nervous.
Philippe. See, I butchered Philippe's name for your. I called him Felipe, and he's still not happy with me. So,
I'm sorry, man. Philippe.
No worries.
All right. Does the active passive income differentiation apply to the capital gains portion? Can you expand on that? What do you mean?
Well, I think there's the capital gains are being paid on, whatever you're going to buy at, let's say you buy at 10 million, you sell at 12 after a few years. And I know, like the active passive, I know it applies to the rental income, but then does it apply to the capital gains part at the disposition?
Yes, it does. And this is where a lot of CPAs get confused. So a lot of CPAs will tell you your rental A gain cannot be offset by rental B's loss. They'll tell you that. But because they're thinking exactly what you're asking, they're thinking, well, the rental A gain is a capital gain, so it goes to Schedule D. And Schedule D stuff is not from a passive activity, so it can't be offset by my rental B loss. But what they're forgetting is that in order for your rental A gain to get to Schedule D, it has to go through Form 4797. Then it goes through Form 8582. And remember, what is Form 8582? It's the most important tax form that you need to know. Literally everything funnels through Form 8582. You've got to know that form. But your rental gains will flow through to Form 8582. And so I love issuing this challenge to anybody that like comes into my ecosystem socially and says, well, my CPA says that my rental A gain was not going to be offset by rental B losses because it's different. And I say, well, have them prepare Form 8582 for you. Because Form 8582, by the time that you get to line 4, you will realize it all nets out. It all nets out. So your gain from a passive activity, because forget talking about, is this rental or is this, forget that. The question is it passive or is it non-passive? If it's passive, it flows to Form 8582. And it's going to be offset by all the passive losses that you're generating. So all those LP investments that you're making, that's exactly where it's going to go. Yeah.
Thanks.
No problem. All right. Moses asked, so to clarify, you certify you materially participate as an LP position if you qualify as a real estate professional. So the depreciation losses go to Form 8582 if no ordinary income to write off and carry it forward. Yeah. So if you are, you cannot materially participate in a limited partnership stake. So you would have to have your own rental portfolio built out, or you'd have to run your own deals. So I would qualify as a real estate professional, and I would materially participate on my own rental portfolio. Then any additional syndication investment that I make, I can group those syndication investments in with the portfolio where I already materially participate. And once I do that, all those syndication investments become non-passive. I hope that helps, Moses. Mona said that was great. Thanks, Brandon. You are quite welcome, Mona. Thank you for joining. I appreciate it. And thank you, everybody else, for joining too. All right. Angel, I recently heard that because of the gains at the turn, if it was a 50K investment, the only way you can offset it is with a 100K investment as the follow. Can you speak on that point, or is there a better way to explain it? Because a 50K investment, the only way you can offset is with a 100K investment. Okay. I see what you're saying. So you're saying that when you, excuse me, when you invest, you put 50K into a syndication, and when they sell, they're giving you an additional 50K. So you've doubled your money, and you've got a $50,000 gain. But what's really going on is when you put that 50K in, you also got $50,000 back as a loss. So you're, because of the passive activity loss rules, the depreciation that they're all claiming, right? So you have a $0 basis and they're cashing you out at 100K. So you've got a 100K gain since you have a $0 basis. So yeah, you would need to find a deal that's going to yield $100,000 of loss in order to offset that entire gain totally. Or when you put that 50K in and then you got $50,000 in losses passed back to you in the first year, maybe you couldn't claim that passive loss because you didn't have any other passive income. Nothing, you didn't have anything else that was selling that was like a passive gain. So that $50,000 is a suspended passive loss. So when the deal liquidates later for $100,000, your basis is 0. It liquidates for 100. Your gain is 100, but you have this $50,000 suspended passive loss that you can then apply to it. So really, your gain's only 50K. Does that make sense? Yeah. Some people are like, I don't know about that one.
I did have one more thing though, but if it's past, if it's a 6-year turn, you can only roll it 5 years, right?
Are you talking about syndications? Or are you talking about like qualified opportunity funds?
Like if you had the 50 that you had 50 that you didn't have to use, so you got that 50 extra in losses.
Yeah,
you can only roll that 5 years, right?
No. If you can't use a suspended passive loss, it sticks on your returns until you die, and then your state uses it. Yep. No phase out. Good question. All right, Jeff, is there an income limit when someone cannot take a K1 deduction? If so, what is that income limit? No, there's no income limit. You just apply the passive activity loss rules. It's either you can claim it because it's non-passive, or it's passive and you have other passive income. Aaron, you asked, is it code section 469 TE32A? Let me actually look. It is, yeah, close. It's regulation section. So he's talking about the short-term rentals, that loophole code section. So if your CPA is like, I don't believe the short-term rental thing, you just point him to Treasury Regulation section 1.469-1T E32A. I'll paste that in chat. All right. Now that I pasted it in chat, it reset. So now I have to scroll back up. Here we go. Ooh, I saw a good one down there from Moses calling me the best. I appreciate that, man. All right, Angel. Is there a precedent from case law on that material participation real estate professional status? Yeah, there's tons. If you check out that article that I linked up a little bit in the chat, we've got it all cited out, all the tax court cases and everything for you. And we get probably 3 or so real estate professional status short-term rental tax court cases every year. And that's a lot. That's a highly litigated area of the code. Behind 3 tax court cases, there's thousands of audits. So just be aware of that. Don't go into that without getting qualified guidance. All right, David, you said, can you please explain a little bit more about the 37% recapture for 5-7-year property bonus depreciation? If I don't have any new loss to deduct for the gain, do I have to pay that rate? Doesn't matter what my income is. No. So good question, David. So that 5-7 recapture, basically from bonus depreciation, it's a maximum 37% rate. But if your marginal rate's 22%, then you're capped out at 22%. Like, it's not going to jump you to 37%. So I hope that makes sense. Moses said, thank you. You're among the best so far in the last year to explain how an LP can immediately qualify for their losses against ordinary income. Thank you. I really appreciate that. If there is a specific form to group your holdings, or is that just your position to proof it and audit? There is a specific statement that you have to include. You basically cite Treasury Reg 1.469-9G. And you have to include a statement saying under Section 469, under Treasury Reg 1.469-9G, I'm making an election to aggregate all of my rental holdings together as one. That includes my syndication investments. You make that election one time. You don't have to do it every year. You only have to do it one time, and it's always in effect, and you'll always get it all grouped in. But if you don't do that and you get audited and you're trying to claim that you did that, they will actually call a technicality on you, and every single argument that you make after that's going to be moot. So you do have to make sure that if you are trying to group syndication investments in with your rental portfolio where you already materially participate, you have to make sure that that election is made or has been previously made. All right, Andy, you asked if you're a managing partner, you're considered a real estate professional. You mean like of an LLC, I guess? I would say no, not necessarily. I mean, you could be a managing partner of an LLC that buys a bunch of rental real estate, but you put a bunch of property managers on the rental real estate. You don't do anything. You're not a real estate professional, right? And you might not be materially participating in the rental real estate. So the key thing to understand about real estate professional status, it's all about the hours, the number of hours and the quality of hours. That's the key. It's not about what you call yourself. We get real estate agents every once in a while. They're like, well, on LinkedIn, I call myself a real estate professional. IRS doesn't care about that. IRS cares about their definition of a real estate professional status. It's all about the number of hours and the quantity of and the quality of hours. So being a managing partner on an LLC will not in and of itself qualify you.
I wonder if Andy meant a managing partner or a general partner. I know that Andy has some interest in syndication. So
okay, yeah. I mean, if you're a general partner, you're on the right track. But like, I could be a general partner in a syndication deal and still have a full-time W-2 job. And if I've got a full-time W-2 job, like I said, I've got to spend an additional 2,001 hours in real estate. And even if I do that, the IRS is not going to believe me. And when I say, well, phooey you, we're going to go to tax court, the tax court's not going to believe me either. So I'm not going to be a real estate professional. So it just depends on your facts and circumstances. The point is that you have to look at those hour tests. 750 hours, more time in real estate than anywhere else. All right. I'm gonna mispronounce this. I'm sorry. Kya. Okay.
I don't know.
Good one. Capital gains taxes. I used to be really good at pronouncing people. I used to run sales for my firm, and I was so good at pronouncing people's names, but I've definitely lost my touch. So I apologize. I know how important it is to get people's names right. Yeah. Capital gains taxes. Bought our primary home July 2014. Lived there till 2018. Moved into our new primary home. Tenant moved in 2019. We have $200K gains. If we sell the house, we have to pay the whole $200K gains. Yeah. So it's the last 2 out of 5 years. So 19, 20, 21. It depends on when you moved out in 2019 or 2018. But you have to live in the property for 2 out of the previous 5 years. And since it was all, I'm not going to get into all that. You can qualify for it as long as like you're closing on you're selling the primary residence right now and you're closing, within the next couple of weeks. And that was still within that 5-year window of you moving out. It doesn't matter when the tenant moves in. It matters when you moved out. So my question would be, when in 2018 did you move out? Was it December 9th, 2018? Then you have to close tomorrow on your primary residence in order to avoid the 200K cap gains. But if it was prior to now, like if it was like September 2018 or something, you're past that window. So you're not gonna be able to qualify, unfortunately. Mike asked, in a JV structure where all materially participate in an apartment, does the operating agreement need to be certain type of? Yeah. So if you're in a JV structure and everybody's materially participating, you got to be careful in those JV structures though, because everybody's got to hit the 500-hour test of material participation. So I don't. Hopefully that's what you're talking about there, and if so, cool. If not, seek counsel. But yeah. So does the operating agreement need to spell out who's doing what? No, it doesn't. I would try not to be called a limited partner in that operating agreement. I would not want a limited partnership class. You just don't want the IRS to be able to hang their hat on anything, like you don't want them to come back and say, well, you're a limited partner, so you can't materially participate. And now you're up the creek without a paddle and you have to go to tax court to fight it. And that's, tens of thousands of dollars. So that would be the only thing that I would watch out for in that operating agreement there. All right. Martin, you asked if as a GP, you also invest on the LP side, is that fine? Yeah. So as long as you're on the GP side, any income you receive from that activity could be considered non-passive, assuming that you're a non-passive GP. So even if you split, even if you do GP and LP, As long as you're on that GP side, you have the ability to materially participate. If you don't have the GP exposure, you don't have the ability to materially participate, and you'll be out. All right, Angel, you said it loses on average 3% each year. What was that in reference to?
Just the dollar. You're saying it's going to take $1.03 the next year to buy your gallon of milk.
Yeah. It's sometimes though when I used to like kind of give the inflation spiel, and people have a hard time understanding like I have $1 and now it's only worth 97 cents. So that's why I like to give that example. It's like, well, the cost of milk's gone up and your dollar doesn't buy it anymore. But thank you. I appreciate that. You are more correct. All right, Mike, your question was meant for reps. Okay, I think we handled that. David, can a syndicator or GP share the bonus appreciation without contributing? Yes, you can. So a syndicator, this is the secret sauce of syndicating deals. If you structure your operating agreement right, a syndicator is I could put $0 into the deal, but I could get that qualified non-recourse financing, a share of it, right? So I've got basis in the entity. And if I structure my operating agreement right, then I can be passed tax losses, even though I put $0 into the deal. Now, if I'm investing in your deal, I'm going to catch you doing that. And I'm going to say, no, I get the tax losses until my capital account reaches $0. Then you can do whatever you want. But I'm the one putting the money in, so I get all the tax losses. But we have clients that are able to work out the economics of the deal with their investors where they get to share in the tax losses up front. So the way that this would work is your operating agreement would say in that profit and loss section, it would say losses are split based on economic interest. Really simple, right? Most operating agreements say we're going to allocate losses to those who contributed capital first, those who have unreturned capital contributions. That's what most operating agreements say. So that means if I put $100,000 in, you are going to give me $100,000 in losses before you move on to the next step of that loss allocation. So the very first step is you give everybody back their unreturned capital contributions in losses. Then you split 50-50 or GP gets it or whatever. But, we've seen it where people structure operating agreements where they just say we're splitting it based on economic interest, or we're splitting it 50-50 or 70-30 or whatever it is. And if that's what your operating agreement says, then yeah, you can do it as long as your investors agree. Be upfront with them, though. Be upfront with them.
How are you holding up, Brandon?
I'm good.
You need some tea, some lemon.
No, I'm good. I'm good. I can go a couple more minutes here. I just got a little wigged out though because there's a Brennan Hall in here.
I saw that.
I was like, I did not type that.
I thought that was your twin brother or something. Come on.
I've never been on a meeting or a presentation or anything where it's that close. So cool, man. I was like, why did I type that? I'm not that sick. All right. If one of your passive syndications sells and you have some suspended losses, but not enough to offset all of the gains for the specific sale, what type of gains are offset first? So you would offset your depreciation recapture first. I don't know if that's what you're asking, but any sort of losses.
Yeah, because some is taxed at a higher rate. So I was wondering, were you offsetting the higher tax stuff first to get rid of that and left with the lower tax?
Yep. That's exactly how it works. Yep. Great question.
Thanks.
All right, Umer, for a real estate professional, can flipping and wholesaling gains offset the passive rental losses? No. Well, yes. Well, hold on. If you're a real estate professional, you can be a real estate professional from your flipping and your wholesaling, because that's a real property trader business. So, I like used the example as a real estate agent earlier where I'm a real estate agent full time. I'm a real estate professional, but if I don't materially participate in my rental activities, they're still passive. Same thing with flipping, wholesaling, building, reconstruction, development, all that type of stuff. All of that is real property trader business. So I can be a real estate professional by engaging in those activities, but I always have to materially participate in my rental activities. So if I materially participate in my rental activities, then yes, my rental losses can offset my gains from flips, wholesales, developments, new builds, brokerage, whatever I'm doing. But the reason I said maybe is because you said gains offset passive rental losses. So I'm very big on terminology, and I try to educate all of our clients on how to use passive and non-passive, the terms non-passive and passive. You would not have passive rental losses if you were a real estate professional and if you were materially participating in the rentals. You would have non-passive losses. and those non-passive losses would offset your non-passive income from the flips and the wholesale. So I hope that makes sense. All right, Angel, I've seen where the depreciation passes the GP at GP is 30% and then distributed. Is that what we were just kind of talking about with that tax split? Maybe she jumped off.
No, I'm here. It was when David was saying, can the GP basically split up the depreciation even if not everybody pays into it? And we're actually currently in that, where they expect the depreciation, the 30% of the GP to come to the GP and then be distributed pro rata. So like based on the GP split, even though not everybody's paying in.
Yeah, I mean, it really depends on how you structure the operating agreement. Do you have a CPA that you're working with on that, or are you just an attorney?
We're using Dugan.
Who's Dugan?
Kelly.
Is that a CPA?
Dugan.
He's a lawyer.
Lawyer. Okay. Is he a tax attorney? So you need to get with a CPA then that understands that stuff, because what you don't want to do, you don't want to get everything locked in and then get to March and then come like hire my team and my team goes, yeah, what you just said is not what's actually in the operating agreement. And unfortunately we have to go with what's in the operating agreement. So you have two choices. We prepare all the K1s with what's in the operating agreement, or you tuck tail, you go back to your investors, you get them to re-sign an operating agreement by March 15th. You got a tight window. And that's not going to look good. So I would highly, highly, highly recommend that if you're not doing something straight up being we're passing all losses back to our limited partners until their unreturned capital contributions reach zero. And then after that, GP splits. If you're not doing something straight up like that, make sure that you got a CPA on your team that's going to go through that operating agreement. We provide that service for you or for clients at a fixed rate, so you can hit me up afterwards. We have a team that does it all day long. So, yeah.
And my husband's standing right here, and I'm like, "Did you just hear that?"
I cannot tell you guys, if you're interested in being a GP, I cannot emphasize enough how important it is to get this right up front. It's okay to make mistakes, but it's not okay to make mistakes in March of the following year, because that's when all the investors want their K1s, and they're going to be really, really pissed if they have to restart this entire process. We've done it with clients before. So just you want to get it right up front. It's going to cost you a few $1,000, but it's going to save you a lot of headache, and you can use it as a template going forward too. So, all right. Sarwar, how to track the number of hours for real estate professional status qualification. Yeah. So we talked about quality of hours, number of hours for real estate professional status, material participation. I've been tossing that around too. That's all quantity hours tests as well. So you got to track your hours. There's applications out there that you can use. There's one that this person like came through one of my courses, and they went and developed something called Reps Tracker. So that's like an app, like an iPhone app that you can use. I've not used it, but apparently it's pretty good. What I recommend is just using Google Sheets, because you can put it on your phone. It's a cloud-based system. It's a spreadsheet. Everybody knows how to use spreadsheets. You have to put the date that you're logging the time, the description of what you're doing during that time, the property that it applies to, and there's the amount of time. I always forget the amount of time. I always get to that, and I was like, there's one more really important thing, but you have to actually log the amount of time that you spend. So on the description, on the notes, really important for everybody here. If the Build Back Better plan passes, the IRS is getting $45 billion specifically for enforcement, which means audits. $45 billion is like 4x the entire IRS budget today. So we're going to see audit rates skyrocket. The only way that you're going to protect yourself is if you take amazing notes today. So not that you can count this webinar as a real estate professional hour. You cannot. But if you could, you would notate, I was on this webinar with Brandon Hall, and we went through section 469, and he told me that the most important form was form 8582. Now, that might seem like a lot, but it's really not in the moment. You just document what you're doing, because you want yourself, think about your future self 5-6 years from now. You want to be able to very clearly recall what you did at any given moment. Do not be the person that puts 8 hours down to set up a VRBO listing. I used to take that, right? I used to be like, oh yeah, that makes sense. And then I bought a beach home and I set up a VRBO listing, and it took me 45 minutes. So now I'm like, you guys are liars. This is not true. So don't be that guy. Don't be the guy that just puts, 1 hour for 70 straight rows and then just puts emails for 70 straight rows, because that's not going to fly either. You got to be specific. You got to be detailed. You got to remember what you're doing 6 years from now. So that I recommend Google Sheets for that type of tracking.
Thank you.
No problem. Angel, you asked, can you reverse the election? What are you asking there?
So it looks like she left. Oh, there she is. Coming back. Angel, your question came up. You want to unmute yourself and
Sorry, my husband was dropping off a wreath. We're in fundraising season.
your question. Can
you asked, can you reverse the election? We're currently GPs for our current deal.
Yeah, so we have our own personal rental portfolio that's residential, and we love property managers. We're on the active side of a deal as GPs, and we are absolutely materially participating. So can that like reverse in with that election that groups them together? Yeah.
You have a different situation than what I was trying to describe. I was basically trying to describe that if you're an LP in a syndication, you cannot materially participate, but you can group that LP stake in with your own rental portfolio where you materially participate. But if you have your own rental portfolio and you've got a bunch of property managers, but then you're running the deal on this syndication, that's not an LP stake, right? That's different. So you could hit all of your hours on the one deal, and then you could group all the rentals into that one deal where you already materially participate.
And then we can group in the stuff that we're passive in as well.
Yeah.
Cool.
Yep. Pretty powerful. Good position to be in.
We're almost
You're playing
there.
the cash flow quadrant very well. All right. Martin asks, can you add this specific election rule to the group syndication? I think I hit that. Somebody said, thank you. This was super helpful. Thank you. I appreciate that. And then Jill, I missed your answer. Is flipping and wholesaling active or passive? That is considered non-passive, which you could call active if you wanted to, but non-passive income. So that is in my non-passive bucket. Any business that I'm running is going to be in my non-passive bucket. If I invest in a wholesaling business or a flipping business as a JV partner and I'm just the money guy and I don't do anything, then it's passive to me. But if I'm the one running it, if I'm the one managing the day-to-day, finding the deals, running the contractors and all that stuff, it's a material participation activity for me. So it's going to be in the non-passive bucket, and my rentals are still in that passive bucket unless I materially participate. All right, Moses, would you have an amendment? Would you have to do an amendment if I did not group my LP stake into my active material participation, my material participation status with my other business income? I actually don't know off the top of my head if you can amend. You can. There is a safe harbor where you can go back and retroactively apply the election to whatever the first tax year was. You only have to do the election one time. So the very first thing that like if you were to ever join us as a client, we would go, if you were doing this already, we would go and seek out that election in your prior tax returns. We would try to find it. And if we didn't find it, we would apply that safe harbor. But yeah, you can, there is a safe harbor. I don't remember what the technicalities are, but I would just check that out. Can you write off passive losses if you have a W-2 income greater than 150K? Yes, if you qualify as a real estate professional. That 150K mark, that if you earn less than $100,000, you're able to claim a $25,000 passive loss allowance. So you don't have to qualify as a real estate professional. I don't have to do anything crazy. I just earn less than 100K. I buy a rental property. It creates losses. It's passive, but I can claim up to $25,000 of those passive losses because I earn less than 100K. That's one of our exceptions to the rule. So when I send you these slide decks, go back through and view those three exceptions. It'll talk about that. But the one thing that I do want to mention, above 100K gets phased out. So like we'll get clients that'll be like, all right, I'm at 165K. So I'm going to contribute 15K or 15.5K to my 401K. That way I'm at 149.5 and I'll get $25,000 of loss allowance. But the way that it works is you're pretty much phased out at 149.5. You can only use a $250 or $1,000 or something loss allowance. So so you really have to drop your income way, in between, like the 125K mark. That's really, if you're trying to like drop your income specifically for this exception, you want to be aiming for at least 125K total income. Otherwise, it's probably not worth it for you. All right, James, you said deciding my first flip should close this year or next year. 2022 will be flipping frequently. Curious if there's a general answer. Are you selling or are you buying this first flip? Well, tell you what, I'll just actually give you the answer. If you're buying, it doesn't matter. It doesn't matter when you close. All your costs are going to be capitalized to the building, the flip, and it's going to be considered inventory. So you don't get to claim any costs until you liquidate your inventory. Okay, you said you're selling. So on the flip side, if you're selling with the flip side, see, I got jokes. All right, if you're on the flip side and you're selling your flip, it just depends. It just depends. I mean, if you asked me this and you were my client, I would look at your 2021 income and I would try to make an assessment of, is it more tax advantageous to sell now, or is it more tax advantageous to push to closing to January 2nd? And that would be largely a discussion, based on how big you think you're going to grow next year. My experience working with flippers and wholesalers is that they all want to get really, really big, really, really fast. They want to see tons of success, but the first 12 months is typically a dud. So I might tell you, push it to next year. Not that I don't believe that you can get big. We've got guys that make millions and millions of dollars flipping and wholesaling, and they started out with nothing, but they also, their first 12 months was a dud. So I might tell you, push it to next year if we feel like that might actually be a dud. But if you don't have much income this year, I might just say, try to accelerate it to this year. So it just kind of depends. All right, Jeff, I've been the money guy who loaned on a flip, but was also asked to JV in the deal to manage it, are both the same. It just depends on what your participation is. Like when you say manage it, I would ask, what does that mean? What are you managing? If you're just doing like investor level management, then you're probably still not materially participating. You got to think of like material participation as like walking through the property and buying supplies and taking them to the property and, yelling at the general contractor. Not that general contractors like to be yelled at, but that's just that's the material participation piece. All right, Brandon. Lots of Brandons in here today. If I just want to be passive through all my investments, then all the real estate professionals doesn't apply. So I just need to focus on Form 8582 and reinvest. Yeah, exactly. Yeah. So if you don't want to be a real estate professional, and I mean, I would encourage a lot of you to not be a real estate professional because it is hard. It's hard. It's highly litigated. You're going to get audited if this Biden tax plan passes. So it's just stressful. So if you don't have to do it, then just do the rich dad, poor dad, just get your cash flow streams offsetting each other. Don't pay tax. We have a couple clients that do that, and they just look at their Form 8582 every single year, and they start making decisions based on that. Should I sell property because I've got these large passive losses? Do I need to buy new property, buy new syndication deals to create additional passive losses? Yeah, it's just looking at that Form 8582 and manage it effectively. So yeah, simplifies it for you. No problem. All right. Successfully churned through all the questions.
Oh my gosh.
Lost my voice in the process.
Wow.
It was good.
Hey, not only was that a ton of great info, but he suffered through his cold, his sore throat, and man, we appreciate it, Brandon. That was great stuff. Really appreciate y'all coming out, making sure that nobody else has any other questions. So again, happy holidays, everybody. I hope you got a lot of value out of that. I certainly did. And Brandon, can't thank you enough.
Yeah, thanks, Brandon. Thanks for pushing through it, man. You hit all the questions, even the ones people didn't ask. So
yeah, no, thank you guys. I appreciate it, and I always appreciate people that are willing to sit through an hour and a half tax talk. So thank you to all the participants as well. Yeah, thanks, guys. I appreciate it.
Yeah, great questions. I have a question, but I'm not going to ask it because I feel so bad for your throat. But if I email you, could you please answer?
Yeah, I just need to figure out, like, if anybody's got tips on how to not get sick with a 2-year-old send them my way, please.
That's
I'm at
awesome.
the point where I'll pay you for them. I'm just like, I've been sick every week for a good 3 months. It's been awful, just with different things: head cold, stomach bug, all sorts
Part of
of
the
fun
joy,
stuff.
man. You got to embrace it.
That's what everybody says. And I'm just like, you know what? No, I'm a driver, man. I've done a disc survey. I'm a high driver. I'm just like, there's got to be a solution.
Nice.
Yeah, wait.
just
If it could be
no child
daycare.
care. You know, keep them at home.
Well, that was my
That
solution.
has
My
different
wife's-
consequences.
yeah, exactly. My wife's not into that. She's like, nope. So
We tried the mask on my kid, my 2-year-old in daycare, and it sort of worked, but then he takes it down. So
well, I'm just thinking about wearing the mask in my house.
Yeah.
it's just my son comes up and wants to like give you a big sloppy kiss on the lips, and how do you turn that down? You can't turn that down.
No,
and then afterwards, you just immediately regret it.
Yeah.
I'm going to pay for this next week.
You are. All right, folks. Any last questions? Keep Brandon's throat in mind. Lots of.
I think that's it.
I think people are saying good night.
Thanks a lot, Brandon. Really
Yeah,
appreciate
thank
it,
you
man.
so
Thank
much.
you for your time.
It was very
Thanks,
good.
everyone.
Thank you, everyone.
Thank
Have a
you,
good
everyone.
week.
Thank you.
We'll do it again. Bye-bye.